So at some point, if you're off on those numbers, you're going to see carriers in a similar method either pull out of the restaurant space, pull out of workers' compensation, pull out of California.
Welcome to the Self-Insurance Podcast brought to you by CRMBC. Every week, we're interviewing industry experts, restaurant operators, and brokers to talk about the world of workers' comp self-insurance in California. Welcome to the Self-Insurance Podcast. My name is Kaya Stanley, and I'm the CEO of CRMBC, California's only restaurant workers' comp self-insured group. Today, I'm joined by Chad Hoxie, Executive Vice President for Alliant Insurance Services. Welcome, Chad.
Excited to be here. Thanks for having me.
So the purpose of this podcast is because we want to provide lots of value to our members of information that they need to know from different industry experts, best practices from other operators, regulators, brokers. And today I'm super excited to hear from Chad because Chad has a very unique perspective. He's been on the carrier side, he's been on the broker side, he's been on the underwriting side. So all of the different aspects that go into creating a self-insurance group, Chad, you've sat in every single one of these seats. Tell us a little bit about your background and how you got here.
Yeah. So actually, I'm one of those odd people who wanted to go into insurance. In college, that was the plan. I don't run into many people like that. So right out of college, I went into insurance. I've worked in several roles from audit, underwriting, claims adjusting, compliance roles. That included I've done rate filings, form filings, building pricing algorithms, and really treated that as sort of a secondary education with the goal to learn and absorb as much as I could on the insurance carrier side of the business, and then move into a client supporting role on the brokerage side to really help clients, restaurant operators navigate the world of insurance.
It's especially interesting to talk to you because Alliant really has been around since this group formed over 20 years ago. And it's for people who aren't aware of how this works. When a self-insured group forms, it's people in a common industry coming together, deciding that they want to self-insure a risk. And in our case, it's workers' comp. And there's very specific rules about how we form the group. We have a board of trustees. We've got our underwriting. We've got our administrator, our third-party administrator, and then we've got a broker community that works with us to both educate members, to bring members in. And at the time that this group was started over 20 years ago, there were certain market conditions that we're sort of seeing hints of happening again now. And Chad, I wanted to have you on to talk about these market conditions and how it impacted why CRMBC formed in the first place, but then all the ups and downs that we're seeing and where we are today. So can you talk a little bit about those market conditions?
Yeah, absolutely. So if we think of insurance, it's a cyclical industry. So much like other cyclical industries we see highs and lows with the pricing. We see a lot of variability come through with pricing driven by various dynamics. And what we saw around the time frame that CRMBC came into formation was a massive exodus of insurance carriers leaving California. And this was creating a supply and demand issue. When early 2000s, we saw the 10 largest insurers controlling about 80% of the market. So the supply and demand was really skewed. What the goal and the purpose of CRMBC is it brought some like-minded restaurant operators together to more or less create safe harbor from the market dynamics. And it brought stability into the restaurant owners' lives as we saw the market going through these changes.
Which is especially important to know because sometimes brokers and members can get stuck with the next shiny object and they think, oh, I'm getting this low rate over here. I'm going to leave, or I'm getting a better deal. And they don't realize that some of that is artificially created because traditional insurance carriers have a much larger risk pool. So they have the ability to buy rate but it's artificially low, so they're not collecting enough to cover a member's claims, and they end up adjusting that at some point. And talk a little bit about that phenomenon.
Yeah, so the rate environment in California is extremely dynamic. And if you look at a historical basis, you can see significant swings with highs and lows. And for example, if we look at the average charged rates per $100 of payroll across all industries, using 2003 as an example, we saw an average charged rate per 100 of $6.32. 2009, that was down to $2.18. And it's really interesting because just as our restaurateurs are trying to manage their company financials, their balance sheet, their P&L, you have insurance companies doing the same. And there's multiple dynamics. So one, you're going to have the unknown of what are we ultimately going to pay out on these claims. So in California, where you can have claims go on for maybe 7 years, as an insurance company, you don't know your cost of goods sold for 7 years. And if you're not used to writing a certain industry, so say you think, hey, restaurants look great, let's go start writing restaurants. If you're not familiar with restaurants, there can be a lot of unpredictability in those results. The other aspects that come into play is just what are carriers doing as far as their growth plans, their exit plans. There's all these different things that become unknowns that in a self-insured group, as we're a member-owned organization, and there's so much clarity in what the mission of the group is. The plans to be a stable market in California, like basic end of story.
And it's a really good point, because we all know, I guess those of us in the industry know, that rates have been artificially low for a long time, and there's going to be a correction at some point. And that's one of the things that people are talking about with regard to the market. None of us have a crystal ball, but we can learn from the past, and we can learn from the cycles that we've seen in the past. So based on what you saw from 20 years ago and what's happening right now, what do you think is happening in the market right now?
So it gets really interesting when we see the dynamic of a group of carriers chasing business, and more or less, you have some new entrants to the market that are quite frankly trying to gain market share, as they should be. But what happens is you get this competitive environment where maybe the actuarial isn't lining up with what the rate's going to be. So at some point, if you're off on those numbers, you're going to see carriers in a similar method either pull out of the restaurant space, pull out of workers' compensation, pull out of California. It's very similar what some of our restaurant groups might have seen during the time of COVID, where suddenly we saw a lot of work comp carriers that were very aggressive to write restaurants take a pause on hospitality across the board. We don't know what this COVID thing's going to be, what the outlook for restaurants will be. A lot of you aren't operating, or you've changed your operations. And so we saw how quickly the market can change then, which with the world of self-insurance, it's a very different dynamic. And one of the neat things about CRMBC being a group self-insured is it gives restaurants access to the world of self-insurance, which is normally you're going to see only very large companies, playing in that world.
And so that brings me to the next point, which is a lot of people, we get different kinds of members into CRMBC. Some came because their brokers told them to. And some came because maybe they had a shock loss in the traditional market, and we were able to look at their operations and set aside that shock loss and look at how they're doing. So we were able to give them a reasonable rate. But then there's the majority of our members know that this is a business decision. It's not a commodity. They're joining a self-insured group because they understand the benefits of self-insuring. And you mentioned it earlier about the stability of a self-insured group. And we say it all the time. Over the last century, self-insured has been steadier than any other type of insurance, and that's the reality. But some people are always going to jump ship because they say, "Oh, I got a lower rate today." But to your point, over time, a self-insured group or self-insurance in general is just the steadier option, and you can speak more to that too.
Yeah, and what gets really interesting when you look at things from that perspective, sometimes if I see a really low rate, I want to think about it in the same way of how could I afford to put a rate this cheap out? Where are my claims? How are those getting handled? What does the claims team look like? What is my underwriting? What does my loss control look like? Am I really just getting a piece of paper that's going to satisfy my requirement to have work comp? Or am I really getting a resource that knows, understands, and can support my industry? And sometimes when you see those very low prices, again, kind of going back to your own P&L, there's going to be something that's missing. And so we do see that sometimes. But one of the nice things, going back to some of the people that have come into CRMBC and what we hear from them as what's really changed the game for them, is now we have underwriters that just underwrite restaurants, loss control, they're just doing loss control on restaurants, claims adjusters that are just doing claims on restaurants. Then add in the fact that we're all working in a collaborative environment where all the other restaurant operators are members that want to see you succeed. And so the communication from that aspect is really different from something you'll see in any other method of securing workers' compensation.
Yeah, it is interesting when we have our board meetings. It does become sort of like a sharing of best practice and masterminding, and we want to create more of that, because for a while the group got so big that the kind of the one-on-one aspect of it is gone, and now or not as strong as it was, and now we're really rebuilding that with the new changes that we've made. You know, we've got the new administrator, the new TPA. We're really excited about bringing all the people closer together so that you do get that added benefit of having that network of other operators who are best in class, because really we do attract the best in class restaurant operators because they understand the sophistication of self-insurance and why that is such a benefit, both in terms of control but also you mentioned when a carrier is rating something so low that there's no chance that they can properly service the account. Then what we know, but let's talk a little bit about what happens to the XMOD. And so this is why I said this is kind of like a false sense of security that is going to come back to bite them down the road. So talk a little bit about the XMOD.
Yeah, that is a really great point to make when we talk about self-insurance. And when we talk about the difference between the way CRMBC can look and price something for a restaurant versus the standard market. In the standard market, you have a pricing algorithm that's basically going to take a look at your payroll, divide it by 100, times it by a rate, take what that comes out to, multiply it by an experience mod, which the insurance carrier is required to use. And then the underwriter has a discretionary level of credits and debits that they can use. Now, where the problem comes is underwriters have a limited amount of credit that they can apply by virtue of their filings. So, for example, if you are running a pizza restaurant and you used to do a lot of delivery, you decided, I'm having a lot of claims from delivery. This doesn't make sense. I'm going to stop doing delivery. And you know what, also in the world of Grubhub, Uber Eats, I don't even think I need it. In the standard market, you're going to see your experience mod, which was developed from all these delivery claims, still impacting your pricing. Whereas in the world of self-insurance, we don't have the experience mod tied in, so we can look at what are your operations doing at this point in time, and where do we see the true rate coming in for what you're doing now, and what claims might look like with that delivery out of the picture. And it becomes especially important if you think about if something was eliminated that was a revenue generating aspect of the business, that revenue is now gone, yet the expense associated with that is still there.
Chad, we literally had 3 groups that we wrote this year with similar things like that. It wasn't delivery, but it was shock losses. But the shock losses were very narrow. They were not representative of their overall business, and they were getting rated out, astronomical rates in the traditional market. And we were able to bring it in, look at it with our underwriting team exactly like you were describing, and isolate those things and say, okay, this does not, because we're not tied to the X mod. And so it's a big opportunity for us. And it's also a great opportunity for restaurant owners and operators and brokers who are dealing with shock losses.
Yeah, it's really one of the fastest ways to get at some pricing equilibrium for that, because the experience mod floats on your record for multiple years. So you can be 3 years out from those changes and you're still having that impact your pricing.
This has been such a great conversation. Thank you so much for this. Before we go, what kind of advice would you give to either a broker or a restaurant operator who's not really sure? They're worried about the exposure, or they're worried about self-insuring because it's a new thing and they're used to their traditional insurance. What advice would you give to them?
Yeah, so I would look at it as they should look at what self-insurance brings to the table. I think, kind of going back to your comment on where we have some people looking at insurance as a commodity, I think it's really important that we stop looking at insurance as a commodity. And this is whether you're in a self-insured group or you're in the standard insurance market, wherever you're, even take insurance out of the equation. And I think one of the important things is take a look at it outside of it being a commodity and take a look at all the benefits. Take a look at the pros and the cons, just as you would. What are you getting from your current insurance arrangement? What are you going to get out of the self-insurance? I think some of the feedback I hear from my clients that they really like, going back, they love the networking, the supportive group environment. And I think that's a big win. And I look at self-insurance, it's not terribly new. We've been doing this since the early 2000s. So we're not coming in as a startup saying, hey, this is, we think this is going to work.
Right.
We have very good people in the group, and we have extremely good partners in the claims, in the administration. The broker community is very strong. The broker community that works with CRMBC is not new to group self-insurance either. And so I think it's something I would just encourage people, take a look at it, get a feel for it. Don't just write it off.
Thank you so much. And to our listeners, if you have any questions or there's another topic that you'd like to hear about, email us at info@crmbc.com. And thank you so much for joining us. We'll see you next time, Chad.
Thank you.
Thank you for joining us for the Self-Insurance Podcast, brought to you by CRMBC. If there's a topic you'd like to learn more about, or if you have any questions, just email us at info@crmbc.com. Remember to subscribe, like, comment, and share, and join us again next week for more tips on self-insurance.